Welcome to the deep dive. Today we're taking a close look at Fujitsu, really digging into their Integrated Report 2024.
Yeah, it's quite a comprehensive document. Covers their business units, financials, future plans, everything, really.
Exactly. And, these reports can be dense. So our mission today is basically to pull out the key stuff.
Give you the highlights, the main takeaways.
Right. A shortcut, if you like, to understanding where Fujitsu is now and where they're headed. We want you to feel well-informed on their strategy.
So we'll break down those business segments, look at the numbers, the financial performance.
And also how they plan to create value for shareholders, dividends, buybacks, all that.
It's all about understanding the core trends and the big strategic moves they're making.
Okay, let's jump in. First up, the business segments. They start with their big purpose statement.
Ah, yes. To make the world more sustainable by building trust in society through innovation. It sets the tone.
It does. And they've got this 3-year plan, 2023 to 2025. They're framing it as like preparation for growth starting in 2026.
And 3 main pillars for this prep phase.
Yeah, first, transform the business model and portfolio. Second, ensure reliable support for customers modernizing their IT.
And third, crucially, improve the profitability of their international business. That's been a focus for a while.
Definitely. And supporting these initiatives are 4 key strategies: technology, people, business model portfolio, and customer success regional strategy.
It's all interconnected, really. You can't pull one lever without affecting the others.
Okay, so let's talk about service solutions. This seems to be where the real action is right now.
Absolutely. Revenue was up 7.7% in fiscal 23. That's 2,137.5 billion. Solid growth.
But the really eye-popping number is within that, Fujitsu Uvance. They're offering for DX, modernization, and this SX or sustainability transformation.
Right. Uvance revenue was up 84% year on year.
84%
Yeah.
to 367.9 billion. And orders were up 80% too, hitting 449.3 billion.
That just shows the massive demand, for these kinds of digital and sustainability-focused services. Companies are really investing here.
It really puts Fujitsu in a potentially strong spot, doesn't it?
Yeah.
If they keep that momentum.
For sure. And they're aiming high. Target for Uvance revenue is 700 billion by fiscal 2025.
700 billion. And they're also targeting a 5% share of the global SX market.
Which they estimate will be an 8 trillion market by fiscal 25. So 5% is still a significant chunk. It shows their ambition.
And it's not just top-line growth in service solutions. They're focused on profitability, too.
Yes, the delivery transformation piece.
Yeah.
Standardizing, automating.
Bringing work back in-house sometimes.
Exactly. And it seems to be working. Gross margin increased by 2 percentage points.
Up to 35%, which is pretty healthy for services.
And that fed through to the bottom line. Adjusted operating profit jumped significantly to 237.2 billion.
Yeah, the margin there went up 2.9 percentage points to 11.1%. So they're not just selling more, they're selling more profitably.
Which is key for sustainable growth. Right?
Definitely. Another big push is consulting. They want more consultants.
A lot more. Aiming for 10,000 by fiscal 2025.
Split between business and technology consultants. 3,000 business, 7,000 tech.
And they're investing heavily to get there. 20 billion in fiscal 24 alone for reskilling and hiring.
That's a serious investment. And they're rolling Uvance out globally, focusing on specific industries, security.
And the 3S platforms, SAP, ServiceNow, Salesforce, those big enterprise ecosystems.
Becoming experts there is crucial for landing those big transformation deals.
It is. And strengthening their consulting arm makes sense. It allows them to lead those strategic conversations with clients, not just implement tech.
Okay, let's switch gears to hardware solutions.
Yeah.
The picture there is, well, a bit different.
Yeah. Revenue was down slightly in fiscal 23 by 2.2% to 11,108 billion.
Though system products actually increased, it was network products that declined.
Right. And that drop in revenue impacted profit. Adjusted operating profit fell to 83.6 billion.
What's the outlook for fiscal 24 here?
They're forecasting lower revenue again, around 1,030 billion, and adjusted operating profit around 70 billion. So still facing some headwinds.
They're also making changes though, right? Restructuring.
Yes, carving out some lower profit international businesses, restructuring in Europe.
And they set up that new company, Phyllis Technologies, Inc., for their domestic server and storage business.
It looks like they're trying to streamline, focus on the more profitable parts of the hardware portfolio. Makes sense given the pressure.
Okay. And briefly, device solutions.
Also saw revenue decrease in fiscal 23, and adjusted operating profit was way down.
Why was that?
mostly weak demand for semiconductor packages. That market can be pretty volatile.
Ah, okay. And they're also transferring their shares in Shinko Electric Industries.
Yeah, another sign they're reshaping their portfolio, maybe reducing exposure in certain device areas.
So stepping back a bit, there's this overarching One Fujitsu program. Tell us about that.
It's about using data better internally, data-driven management. They have one CRM globally already,
Since April 2022, yeah.
and now they're rolling out one ERP plus Garak,
Yeah.
going live in Japan this October, then globally by fiscal 28.
What are the goals? Better visibility.
Real-time visibility, yeah. Easier system maintenance, quicker response to market changes, more productivity through standard processes, the usual ERP benefits.
But what's interesting is how they connect this internal effort back to their customer offerings.
Right. They say their own experience implementing these systems, especially SAP, ServiceNow, Salesforce, the 3S, strengthens their consulting capabilities.
Like eating their own dog food, basically. They can advise clients based on their own journey.
Exactly. It makes their consulting pitch more credible.
And one more structural point,
Mhm.
new management leadership since April 24.
Yep, one CEO and 5 vice presidents, designed to speed up decision-making, make things more efficient.
Seems like a move towards agility, which you definitely need in this market.
Absolutely. Clearer roles, faster decisions. That's the idea.
Okay, so that covers the business segments and structure. Let's dive into the financials. Big picture targets first for fiscal 2025.
They've set some pretty high bars. Revenue target, 4.2 trillion.
4.2 trillion.
Adjusted operating profit, 500 billion. Core free cash flow, 300 billion.
And EPS growth, earnings per share.
They're targeting a compound annual growth rate, the CAGR, of 14 to 16% between fiscal 22 and 25.
Those are strong growth ambitions.
Yeah.
How did they actually do in fiscal 2023, the year just ended?
Well, revenue was up year on year, reached 3.8 trillion. So progress towards that target.
What profit?
Adjusted operating profit actually decreased, came in at 283.6 billion.
Why the decrease despite higher revenue?
It goes back to what we discussed. The strong profit growth in service solutions was offset by the difficulties in hardware and device solutions.
Okay, that makes sense. What about cash flow?
Core free cash flow was actually up, reached 197.2 billion.
And that was due to...
Better operating cash flow. They mention reducing inventory, collecting receivables faster, good cash management, basically.
And the EPS CAGR for the first year of that target period, 22 to 23.
It was 12%, so a bit below the target range midpoint, but still positive growth.
Let's zoom back into Service Solutions financials for 23. You said revenue was $2,137.5 billion, up 7.7%.
Right. And the adjusted operating profit jump was really impressive, up 74.2 billion to 237.2 billion.
Margin up 2.9 points to 11.1%. What drove that strong performance?
Primarily the revenue increase, especially the 12% growth they saw in Japan, plus that improved gross margin we talked about.
Even with increased investments.
Yeah, the growth and efficiency gains more than offset the higher spending on things like consulting expansion. It really shows the strength of that segment.
Okay. Hardware Solutions financials for 23 revenue down 2.2% to all $1,108 billion.
And adjusted operating profit down 28.9 billion to 83.6 billion, mainly due to lower network product sales.
And Device Solutions. Revenue down 4.4% to $273.3 billion.
But adjusted operating profit was actually up here by 15.5 billion to 24.2 billion.
Wow, if revenue was down.
Cost cutting. They managed costs well, but they also flagged the withdrawal from the European CCD business will hit future revenue.
Right. And the semiconductor package profit drop we mentioned earlier.
Exactly. So a mixed bag in devices, with cost control helping the profit number despite market challenges.
One standout number for fiscal 23 was the profit attributable to owners of the parent, a record high.
Yes, 254.4 billion, but there's a key reason.
A restructuring in Europe.
Exactly. Lower tax expenses related to that restructuring were the main driver, so more of a one-off boost than purely operational.
Got it. What about the balance sheet at year-end? How does it look?
Pretty solid. Total assets at 3.5 trillion. Equity attributable to owners at 1.75 trillion.
Giving an equity ratio.
Just under 50%, 49.9%. That's a strong position, gives them financial flexibility.
And cash flow statement highlights for 23.
Operating cash flow was positive, 409.2 billion. Investing cash flow was negative, 157.2 billion, reflecting capex and maybe acquisitions.
Which leaves free cash flow at
151.9 billion. That's the cash generated after investments, available for things like dividends and buybacks.
Okay, perfect segue. Let's talk about shareholder value creation. What are their plans?
They state a clear commitment to both investing in growth and shareholder returns. They see it as a balance.
Starting with dividends.
Consistent increases. Fiscal 23 dividend was 26 per share. That was the 8th year in a row they raised it.
Total payout of about $48.4 billion then. And the plan for fiscal 24.
Increase it again to 28 per share. That would be the 9th consecutive annual increase. Sends a strong signal.
Definitely signals confidence. What about share buybacks?
They've been active there too. Bought back $103.1 billion worth of shares in fiscal 23.
And the plan for 24.
Even bigger, they plan to repurchase $180.0 billion worth of shares.
Wow, that's a significant amount.
It is. It shows a strong commitment to returning capital and potentially boosting EPS.
So add the dividends and buybacks together. What were total shareholder returns in fiscal 23?
Came to $151.5 billion, which they note was a total return ratio of 60% of profit.
And expected total returns in fiscal 24.
Around $230 billion, driven by that larger buyback plan.
And they're sticking to their medium-term plan for returns.
Yes, they reiterated the plan for $600 billion in total shareholder returns over the 3 years, fiscal 23 to 25. That hasn't changed.
So a clear focus on returning cash to shareholders alongside the growth investments.
Absolutely. It seems to be a core part of their financial strategy.
Okay, let's wrap up with their assessment of the business moving forward. How do they see things?
They frame fiscal 23 as a solid starting point, pointing to the steady results in service solutions and the progress on tackling those longer-term issues.
Laying the groundwork for future growth.
Exactly. They expect growth to accelerate in fiscal 24, and they're focused on making it sustainable beyond 2025.
Any specific projections for 24?
For service solutions, they're forecasting an 18% year-on-year jump in adjusted operating profit.
18%. That's strong. Driven by
continued revenue growth and maintaining stable profitability in that key segment.
And they expect the market to notice this.
They hope so. They mention anticipating that the share price and PBR price-to-book ratio will start reflecting that service solutions growth and the market's view of their strategic progress by the end of fiscal 24.
Basically, they believe the value they're creating isn't fully reflected yet.
That seems to be the implication, yes. They want the market valuation to catch up with the underlying performance, especially in services.
And they finish by tying it back to their purpose.
Yes, reaffirming the commitment to creating solutions for social issues, hitting those financial targets, and ultimately realizing their 2030 vision.
Which involves a net positive impact through digital services, if I remember correctly.
But that's the overarching goal, yes.
Okay, so let's try and summarize the key takeaways from this deep dive.
Well, clearly Fujitsu is doubling down on service solutions, particularly Fujitsu Uvance. That's the growth engine.
Yeah, fueled by demand for DX, modernization, and especially sustainability transformation, SX.
Fiscal 23 showed this, with service solutions propping up overall results while hardware and devices faced some challenges.
They're actively restructuring those challenged areas and investing heavily in consulting and internal systems like One Fujitsu.
And financially, they've set ambitious targets for 2025, backed by a strong commitment to shareholder returns, rising dividends, and significant buybacks.
All underpinned by that core purpose around sustainability and innovation.
It paints a picture of a large tech company in transition, trying to pivot strongly towards higher growth, higher margin services.
Right. So that leads us to our final thought for you, the listener.
Considering these ambitious targets, particularly around Uvance and that 2030 vision,
And knowing how fast the tech landscape changes, what do you think are the biggest opportunities ahead for Fujitsu?
and maybe more importantly, what are the biggest hurdles or risks they might face in actually achieving that net positive impact vision?
Something to ponder. Of course, if you want all the details, the full Integrated Report 2024 is out there.
Definitely worth a read if you want to go deeper.
Thanks for joining us for this deep dive into Fujitsu.